Hi, everybody. It's been a while. I am constantly astounded how most people approach valuation the way tourists approach a city from the windows of a passing bus. They trust the brochure, the guide's voice, the prices are posted at nearby attractions, but they never step off walking the streets or pushing open a door. And yet they leave convinced they understood the place. I was reminded this year of an occurrence that happened a year and a half ago when I asked several estate agents to value my home. They arrived armed with spreadsheets, comparables, and market reports. Not a single one of them walked through the house. No one stood in the rooms, tested the lights, noticed the renovations, or sensed the way the space lives. The size of the rooms were not taken in consideration, or the flow of the architecture. The valuation delivered without ever looking and kicking the proverbial tires on the asset itself. At the end of the conversation, what they gave me wasn't a valuation of my house. It was the average of other houses, nearby houses, recently sold houses, houses that were merely shared a postcode with me. Not architecture, not style, postcode. Useful data, certainly, but incomplete. Because every real asset, like every city, has details that do not show up on the map. Benchmarking matters, you may say. It gives us common language and a reference point. It tells us roughly where we are standing, but it is not a substitute for judgment. When benchmarking becomes gospel, it quietly absolves us of responsibility. We stop thinking, stop questioning, and stop doing the hard work of understanding what is actually in front of us. True, valuation begins where the herd stops. It requires walking the asset, not just circling it. It requires asking what is different, not only what is similar. Amenities, constraints, optionality, risks, and potential really reveal themselves in summary tables. They show up only when you engage directly. The same laziness shows up daily in enterprise valuation. From early stage venture capital to growth stage private equity, different players, same mistakes. People anchor to last rounds, market multiples, and third party models, then call it rigor. They inherit someone else's assumption and treat them as truth. But valuation is not a relay race where you simply carry forward the last number handed to you. It is an act of independent thought, a discipline, a willingness to get uncomfortable, to dig, to test, to doubt. As Zolani, my business partner, always says, he likes to kick the tires and look underneath the hood. Sometimes he's been known to go and park outside people's premises just to count the number of customers they get on a daily basis. This all because assets, whether houses or businesses, do not reveal their true worth to those who refuse to step inside. And on that note, welcome to Call, Confessions of a Recovering Entrepreneur, a place where we strip away the hype, the highlight reels, and the overnight success stories to talk about what it really takes to build something meaningful. I am Yongama Square, and today we're talking about something every founder secretly obsesses over: valuation. So, why startup valuation is different? Traditional companies are often valued on earnings, assets, or cash flow. Startups are different. I need to repeat this. Traditional companies are generally valued on the basis of their earnings, their assets, or cash flow. Startups are way different. Firstly, there is little to no historical data to base analysis on. The value you are assessing is in the future, and the amount of uncertainty to getting this business to a substantial level is immense. In order to mitigate all this, we usually use a mix of quantitative models as well as qualitative judgment. The five methods we'll cover today are the discounted cash flow, market or comparable company method, the venture capital method, scorecard method, and the Beekers method. Let's briefly double click on each one of these approaches and methodologies onto evaluation. As mentioned, some are quantitative while others are qualitative. A rule of thumb is to use more than two approaches to find a ballpark figures in order to get to some valuation that is within the realm of reality and fairness. For private equity deals where companies have been operating for a number of years, the financial statements will paint the picture and give you clear valuation. So this is not in contention with that philosophy, but more looking at various other methodologies or approaches that are foundational to pre-revenue or early stage startups. So let's start. Discounted cash flow, the DCF. The idea here is quite simple. You need to estimate you need to estimate the cash your startup will generate in the future. Then discount those cash flows back to today's rands, dollars, or renminbis using a high discount rate that reflects the risk. For example, if you project that your startup will generate 10 million rands in free cash flow 5 years from now, and you apply a 40% discount rate, the future cash is worth far less today, and that is the core of the DCF. Now, I've experienced that an accountant uses net present value as a substitute for DCF. Though net present value or NPF, NPV and DCF are closely related, and if you look at the equation, really, they are closely related. But relation does not mean the same. So, for a simplistic definition and illustration of the differences, the DCF calculates the present value of all future cash flows using a discount rate, which we have stated before, while the NPV is the result of taking the very same DCF total and subtracting the initial investment. You may ask, and then what is the purpose of all of this? Well, the DCF exists to estimate the intrinsic value of an asset or business, while on the other side, the NPV determines the profitability of the project in capital budgeting. Slight nuance, but tangible in its difference. So a positive NPV indicates a profitable investment, whereas a high DCF value simply indicates a high projected future value. The DCF method is often used for valuing entire companies, whereas the NPV approach is better for choosing between specific projects. The DCF method works best for later stage startups with a clear revenue and a path to profitability. Also, for when the businesses can credibly forecast cash flows like that of SaaS offerings or ventures that have a subscription model that is clear. I hope that clarifies a little bit in terms of the DCF and the net present value. Let's move on. Market or comparable company method. This is often called the comps. Here, an investor is looking at recently funded startups in the same sector, geography, and stage, and ask, what did similar companies trade at? When this, when we then apply multiples to that value, like revenue multiples or EBITDA multiples to the venture we are valuing. In some ways, it is similar to the intro story, and it can easily be abused by lazy allocators, not willing to take the time and make the effort to effectively calculate the value. But on the other hand, this approach allows for real world comparison. If there is a clear peer group with a recent funding data, it must be cautioned that as an entrepreneur, if your startup is in a niche or emerging market, comms can be very thin, very misleading. So, as the other side of the adage goes, caveat venditor. Next, let's flip the script somewhat. Let's look at the venture capital method. This approach starts with the exit, not the present. The investor estimates what the future, what the venture might be worth in future liquidity event had to happen. Let's say an acquisition or something related. It could also be an IPO. We don't have a good reputation or historical data to support IPOs happening within our market in South Africa. So usually it is acquisition by a bigger company. Then they work back to today's valuation given the return that they need to achieve. As can be understood, this is not quantitative approach at all. The whole model hinges on two big assumptions: the exit value and the required return. If either is off, the valuation can be way off too. So use at your own discretion. But it works very well, especially for guys who are in angel investing. It proves to be a very efficient way of going about it. Next, we'll look at the scorecard and the Berkus methods. These are two different methods, but they're very closely related. And I will try to cover them together. These method, the Berkus method, and the scorecard method, which in some circles is called the bill paying method, have been made famous by specific individuals. The scorecard method is also called the bill paying method. Bierkus method is called the Bierkus method after the gentleman Bierkus who put it together. So let's start with bill paying method or the scorecard method. And this is a technique for valuing pre-revenue early stage startups by benchmarking them against similar recently funded companies in the same sector and region. It adjusts the average valuation based on qualitative factors, primarily the strength of the management team, the size of the market opportunity, the product or technology readiness, the competitive landscape, and the need for additional capital and market opportunity. The scorecard method is largely used by angel investors looking to find an efficient manner to to value a pre-revenue venture. The Beerkes method is quite similar. The Beerkes assigns a monetary value to qualitative milestones. The Beerkes method evaluates a startup across five critical dimensions, assigning up to $500,000 in value per category for a maximum valuation of $2.5 million. Dollars. These dimensions include the development of a sound idea and business model, the extent of the working prototype, team quality, strategic partnerships, and market traction. As you'd hear, much like the bullpen method, they look at certain elements that make up the business. Each bucket might have a cap, let's say up to 250,000 per factor. So a startup that ticks most boxes could value in the low $1 million range even before revenue. The 2.5 million represents the theoretical maximum pre-money valuation under this framework. Both these methods are partly subjective. Different investors will weigh factors differently. So you may get a range of numbers that are rather, yeah, difficult to work with, but they tend to get you to a ballpark that is acceptable if you give it time and understand how the ecosystem works. So, with all of those, how founders should view these methods. So, as a founder, use all of this. Firstly, understand no single method is right. Savvy investors often triangulate. They look at the DCFs for financial story, comms for market context, the VC method for return expectations, and the scorecard or Berkus method for qualitative risk. Secondly, know the stage of development your venture is at. The Berkus and the scorecard are great at pre-revenue. VC model at early revenue, and the DCF is used at growth stage. Lastly, in the mythology of startup culture, valuation is often treated as a scoreboard. A higher number of a higher number signals prestige, traction, and perceived inevitability. Founders celebrate nine-figure post-money valuations as milestones. Well, the media and especially social media platforms amplify all of this. I always think if you have a massive valuation early on, before the business has found product market fit, with repeat customers who find value in your offering, willing and able to pay consistently, you are setting yourself up for enormous emotional damage and failure. The operating reality of entrepreneurship, valuation is not a trophy. It is financial instrument. And when mispriced, it can quietly destabilize everything that follows. And at times, it can also become a financial noose around your neck as you try and live up to the valuation for your investors. For founders, finding fair value rather than the highest possible value may be the most strategically intelligent decision they make. As a parting shot, I'd like to add that valuation is the price discovery process for illiquid high risk equity. It reflects expected growth, risk profile, market opportunity, defensibility, and capital efficiency. When the price is inflated beyond operational reality, the distortion compounds over time. A fair valuation, by contrast, creates alignment between capital providers and operators. We have come to the end of our session. I hope you have enjoyed this episode. More importantly, I hope this gives you some nuggets of information and things to think about that you will use in evaluating your venture as an entrepreneur. And for those who are evaluating other people's ventures as investors, that you'll think twice about taking on other people's valuations, but actually doing the hard yards of putting energy, time, and effort to actually get to a fair assessment of that venture in order to help you with your valuation of the business as an entrepreneur, but also to give the you as an investor, not the entrepreneur, and also to give the entrepreneur a fair assessment that they can live up to and not fall because of the misalignment. Thanks for joining me on the Core Podcast. If you enjoyed this episode, please share it with a founder who is raising, about to raise, has raised before. Let's spread the word. Next time, we'll break down how to read a term sheet without losing your mind. Until then, keep building, keep testing your assumptions, and remember, valuation isn't magic, it's just math, markets, and a little bit of storytelling. I am Yongama Squia. Till next time, keep the core strong.